Silver is trading at $57 an ounce right now, and here's the fact that should stop you in your tracks. That price is 52% below where silver stood just 6 months ago. In January of 2026, silver hit an all-time record high of $121.62 an ounce. Today it's near 57. That's more than half the value gone in half a year. And yet, this is the part almost nobody is explaining properly. Not one single major bank has lowered its 2026 price forecast below where silver trades today. The LBMA consensus is $79.57. JPMorgan's base case is 81. Goldman Sachs says 85 to 100 is achievable. So you have a metal that crashed 52% while Wall Street's targets didn't move an inch. That is one of the largest disconnects in the entire commodities market right now. In this video, I'm not wasting a second. Every part is going to hand you a specific number and what it actually means. Let's get into it. Start with the exact price picture. Silver set its all-time high of $121.62 on January 28, 2026. From there, it corrected all the way down to a mid-2026 low around $54 to $58, a peak-to-trough decline of roughly 52 to 53%. As of the middle of July, it's been trading in a tight band, $57.02 on July 16th, around $58.55 on July 14th, with intraday swings between roughly $56.87 and $59.12. And here's a number for perspective that cuts both ways. Despite crashing 52% from the top, silver is still up almost 49% over the trailing 12 months, and about $19 higher than it was a year ago. So this is a violent correction inside what has still been a powerful longer-term bull market. Both things are true at once, and holding both in your head is the key to understanding this market instead of just reacting to it. Let me put the scale of this move in historical perspective because context turns a scary number into a useful one. A 52% drawdown in silver sounds catastrophic, but silver is notorious for exactly this kind of violence. In the 2011 cycle, silver ran to nearly $50 and then collapsed roughly 70% over the following years. In 2020, it dropped under $12 during the COVID panic before more than quadrupling. Silver is, statistically, one of the most volatile mainstream assets you can trade. Its daily and monthly volatility routinely runs well above gold's. So a 52% correction, while painful, is not outside its historical character. What matters is not the size of the drop, but whether the drop was driven by a change in fundamentals or by a change in sentiment and macro conditions. And as I'm about to show you with hard numbers, this one was overwhelmingly the latter. Now the critical question, why did silver crash 52%? There are three specific, traceable, and importantly reversible reasons. Reason one, the Federal Reserve. Under Chair Kevin Warsh, the Fed held rates at 3.50 to 3.75% at its June meeting and revealed a deeply divided committee. Of the 18 officials submitting dot plot projections, 9 favored at least one more rate hike before year-end, 8 projected no change, and only 1 projected a cut. That hawkish tilt pushed real Treasury yields higher, and higher real yields raised the opportunity cost of holding a non-yielding asset like silver. When you can earn more sitting in Treasuries, shiny metal that pays no interest becomes relatively less attractive. That's reason one, and it's the single largest driver of the correction. Reason two, inflation ran hot in May. May CPI came in at 4.2% year over year, driven largely by energy costs following disruptions around the Strait of Hormuz. That hot inflation print reinforced the Fed's hawkish posture, which fed straight back into higher yields and more pressure on silver. Now, this is worth pausing on because it's a little counterintuitive. You'd think high inflation would be good for silver, since silver is an inflation hedge. And over the long term it is, but in the short term, hot inflation that forces the Fed to stay hawkish and push real yields up hurts metals more than the inflation hedge demand helps them. That's the tension that defined the first half of 2026. Inflation was high enough to scare the Fed hawkish, but not so out of control that panic hedging demand overwhelmed the yield effect. So silver got the worst of both worlds. Reason three, and this is the one unique to silver, 58% of all silver demand is industrial. That industrial exposure is a double-edged sword. When a hawkish Fed threatens to slow economic growth, it hits silver's industrial demand engine directly: factories, manufacturing, electronics, construction. Gold has no comparable vulnerability because gold is almost purely a monetary and investment metal. Only around 10 to 15% of gold demand is industrial. That's precisely why, during this correction, silver fell far harder than gold, and the gold-silver ratio blew out from a May low near 55 to 1 all the way to 69 to 1. When the market fears a slowdown, it sells the metal with the factory exposure and keeps the one that's pure insurance. Now here's the single most important line in this entire analysis. None of those three factors changed the supply and demand structure of the silver market. The correction changed the price. It did not change the thesis. Let me prove that with the deficit numbers, because this is the backbone of the bull case, and it's the part that separates silver from a simple momentum trade. Silver is now in its 6th consecutive annual supply deficit. The Silver Institute's World Silver Survey 2026, published April 15th with research by Metals Focus, confirmed a shortfall of 46.3 million ounces for 2026. And critically, that's wider than 2025's 40.3 million ounce gap. The deficit isn't shrinking, it's growing. And when you stack up the last several years, the cumulative drawdown from above-ground silver stockpiles since 2021 has reached 762 million ounces. Let that sink in. The world has drained over 750 million ounces of stored silver in 5 years to cover the gap between what's mined and what's consumed. That is a structural physical shortage, and it's completely indifferent to short-term price swings on a trading screen. Let me make that deficit tangible, because a number like 46 million ounces is abstract until you frame it. 46.3 million ounces is roughly the amount of silver held in some of the largest exchange vaults, being consumed above and beyond what's produced every single year. The reason this matters so much more than a deficit in most commodities is that silver, once it's used industrially, is largely gone. When silver goes into a solar panel or a circuit board, the quantity per unit is so tiny and so dispersed that recycling it is often uneconomical. So unlike gold, where virtually every ounce ever mined still exists in a vault or around someone's neck, a meaningful share of industrial silver is effectively destroyed as accessible supply. That's why the above-ground stock drawdown compounds year after year rather than cycling back into the market. Now here's why the supply side can't just fix itself, and this is a detail most people miss entirely. Mine production for 2026 is projected at 844.1 million ounces, essentially flat. Why doesn't higher demand pull more supply out of the ground? Because approximately 74% of all silver is produced as a byproduct of copper, lead, and zinc mining. It's not mined for its own sake most of the time. It comes out as a bonus when miners dig for base metals. That means silver supply responds to copper and zinc economics, not silver economics. So even when silver's price triples, it does not produce a proportional increase in silver mined. The supply response simply doesn't materialize the way it would for a commodity that's mined primarily for itself. Roughly 1 billion to 1.05 billion ounces of total supply against demand that keeps outrunning it. That's a decade-high supply figure that still isn't enough to close the gap. And think about what that byproduct dynamic means for a genuine supply squeeze. If silver demand explodes and the price spikes, a pure silver miner would rush to expand production. But when 3/4 of your supply is a byproduct, the only way to significantly increase silver output is to mine more copper, lead, and zinc. And those base metals have their own separate demand cycles and prices. A copper miner isn't going to dramatically ramp up copper production just because silver got expensive. That would flood the copper market and crash copper prices. So silver supply is structurally handcuffed to base metal economics. This is the single most important supply fact in the entire silver market, and it's why analysts keep pointing to the deficit as durable rather than temporary. And the demand side has a floor that gold structurally lacks. That 58% industrial demand component I mentioned as a vulnerability during a slowdown is, over the long term, a powerful engine. Silver is essential to solar photovoltaic panels, electric vehicles, semiconductors, 5G infrastructure, and the AI data center build-out. Every one of those sectors is growing structurally, and every one of them consumes silver at volumes mine supply cannot easily match. Solar alone has become one of the largest single sources of silver demand on the planet, consuming well over 200 million ounces annually as global installations keep climbing. Silver's unmatched electrical and thermal conductivity means there's no cheap drop-in substitute for many of these applications. Engineers can thrift the amount used per unit, but they can't eliminate it. And that industrial demand does not respond to a short-term price correction. A solar manufacturer needs silver regardless of whether the spot price is 57 or 121. That structural demand floor is a feature gold simply doesn't have. Now let's talk about the gold-silver ratio, because it's the single cleanest valuation tool in precious metals, and the number right now is loud. The ratio stands at approximately 69 to 1, meaning it takes 69 ounces of silver to buy 1 ounce of gold. The modern 50-year historical average sits between 60 and 70 to 1. So at 69, silver is sitting near the top of its historical valuation range relative to gold. And historically, when the ratio reaches these elevated levels, it has repeatedly preceded periods of silver outperformance, silver playing catch-up to gold. Consider that the ratio was near 55 to 1 as recently as May 2026, before the hawkish Fed repricing widened it back out. Here's the math that makes it concrete. Using a gold price around $4,049, a compression of the ratio back to 65 to 1 would imply silver at about $62.30. A compression back to 55 to 1 size, a level reached in prior bull cycles, would imply silver at $73.60. And in a true silver mania scenario, the ratio has historically compressed toward 40 to 1 or even lower, which at these gold prices would imply silver well above $90. The ratio isn't a forecast, but at 69 to 1, it's flashing that silver is historically cheap relative to gold. Here's an important nuance about the ratio that most videos skip, in the interest of giving you the honest version. The gold-silver ratio has trended structurally higher over the past century. The old 16 to 1 that gold bugs love to cite comes from an era when governments fixed the ratio by decree, and it hasn't been a natural market level in a very long time. So don't expect a return to 16 to 1. But even acknowledging the structural drift, 69 to 1 still sits at the upper end of the modern range, and mean reversion within that modern range has been a reliable pattern. When the ratio gets stretched towards 70 or above, silver has tended to outperform gold on the way back down. That's the realistic version of the signal, not a promise of 16 to 1, but a well-supported lean towards silver catching up. Now the near-term catalysts, with exact dates and data, because this is what moves price over the next few weeks. Catalyst 1 already fired. The June CPI report, released July 14th, came in softer than expected. Headline CP. I fell 0.4% month over month, the largest monthly decline since April 2020, and slowed to 3.5% year over year, down sharply from May's 4.2%. Core CPI eased to 2.6% from 2.9%. This is silver positive, and here's the mechanism precisely. Lower inflation reduces the urgency for more Fed rate hikes. When rate hike expectations fall, real yields ease. When real yields ease, the opportunity cost of holding non-yielding silver drops. And the market responded in real time. Silver rallied on the print, touching $59.12 intraday before settling at $58.55, up 1.56% on the day. That's the transmission mechanism working right in front of you in a single trading session. Catalyst 2 is the big one still ahead, the FOMC meeting on July 28th and 29th. Now, an important detail, this particular meeting does not produce a dot plot or a summary of economic projections. Those only come out at every other meeting. So markets will be hanging entirely on Chair Warsh's press conference language for signals about September, which is the next meeting that does carry a formal rate forecast. Going in, that soft June CPI print has already shifted the odds toward a hold. A hold, or dovish language hinting the hiking cycle is over, would ease real yield pressure and be bullish for silver. A surprise hike, or hawkish language keeping the door open to more, would extend the pressure and be bearish. This is a genuine binary event on the calendar in less than 2 weeks, and it's the single most important near-term driver of where silver goes next. And there's a deeper structural constraint on how hawkish the Fed can even afford to be, which is a fact almost no silver video mentions. Total U.S. gross national debt stood at $39.39 trillion as of July 6, 2026, with annual interest expense already exceeding $1 trillion a year. That fiscal reality limits how aggressively the Fed can keep hiking, because every rate hike raises the government's own borrowing costs on that enormous debt pile. At some point, the Treasury's debt servicing burden becomes the dominant policy concern, which structurally caps the hawkish cycle. And a capped hawkish cycle, a Fed that can't keep rates high forever without blowing up the federal interest bill, is, over time, deeply bullish for hard assets like silver and gold, which are the classic hedges against currency debasement and fiscal stress. That backdrop is the long-term wind at silver's back, regardless of any single meeting. Now, the analyst targets laid out precisely, because this is the disconnect that defines the whole trade. The LBMA's 2026 Annual Precious Metals Forecast Survey drew on 26 analysts, and their full-year consensus is $79.57 an ounce. JPMorgan's base case is $81. HSBC forecasts approximately $75. Goldman Sachs identified $85 to $100 as achievable if industrial demand holds. And here's the kicker. All of these forecasts were set, and critically, not one major institution has revised its full-year average below current spot prices near $57 to $59. Think about what that means. The price crashed 52%, and the professional consensus did not follow it down. Either the analysts are collectively wrong, or the market is overshot to the downside. That gap between $57 spot and a $79 consensus, roughly a 38% implied upside just to reach consensus, is the entire opportunity and the entire risk in one number. Let me add the honest caveat on those targets, because forecasts are not facts. Analyst price targets are notoriously unreliable in precious metals. The same institutions that now target 79 to 81 were, at various points in past cycles, far too high near tops and far too low near bottoms. A forecast is a snapshot of consensus reasoning, not a guarantee. What makes this particular disconnect noteworthy isn't that the analysts are definitely right. It's that the gap between price and consensus is unusually wide, and that gap tends to resolve one of two ways. Either the price rises toward the forecasts, or the forecasts get cut toward the price. Watching which one happens over the coming weeks will tell you a great deal about which direction the smart money truly believes in. Now the technical levels, so you can turn all of this into an actionable framework. On the downside, immediate support sits in the $54 to $55 range. That's near the correction low and the level bulls need to defend. Bar charts futures pivots put first support around $55.94, with deeper supports at $55.07 and $54.49. Below that, the 52 to 54 zone would be the last line before a deeper flush toward the high 40s. On the upside, immediate resistance is the psychological $60 level, which silver has been probing. Near-term futures resistance clusters around $57 to $58 in the very short term, then $60. Above 60, the next meaningful resistance zone is $62 to $64, which lines up neatly with that 65 to 1 gold-silver ratio target. And the bigger structural resistance sits up in the $69 to $70 region, then the 73 to 77 zone that aligns with a ratio compression toward 55 to 1 and the lower end of analyst targets. The longer-term technical resistance sits at $82 to $84, which is the doorway back toward the prior highs. Let me tie the technicals to the fundamentals, because levels in isolation are just lines. That 62 to 64 resistance isn't arbitrary. It's exactly where the gold-silver ratio math points if the ratio compresses to 65 to 1 at current gold prices. The $73 zone is where the ratio hitting 55 to 1 lands, and the 79 to 81 region is precisely the analyst consensus. So the chart and the fundamentals are telling the same story from two different angles, which is exactly the kind of confluence that gives a level real weight. When your technical resistance and your fundamental valuation target sit on top of each other, that's a level worth watching closely. Now let me give you the honest, balanced read, because that's what separates real analysis from a pump. The bear case for silver is real and specific. If the Fed surprises hawkish on July 29th, if inflation reaccelerates like it did in May on another energy shock, or if a genuine global growth slowdown hits, silver's 58% industrial exposure means it could get hit harder than gold again and retest that $54 support or lower. Silver is more volatile than gold, full stop. The Silver Institute itself and multiple analysts have explicitly warned of wild volatility in 2026 rather than steady gains. UBS actually cut its deficit estimate at one point, and different research houses put the 2026 shortfall anywhere from the low 40s to the 70s of millions of ounces. So even the deficit figure, the cornerstone of the bull case, has a genuine range of estimates. You should never treat any single forecast as gospel, and anyone who tells you silver has to go to $100 is selling you certainty that doesn't exist. That's the honest bear side, stated plainly. But the bull case is structural and it's stubborn. Sixth consecutive annual deficit. 762 million ounces drained from above ground stocks since 2021. 74% byproduct supply that can't respond to price. 58% industrial demand from growing sectors that don't care about the spot price. A gold-silver ratio at 69 to 1 screaming relative cheapness. Softening inflation at 3.5%. A debt-constrained Fed with a $39 trillion problem. And a Wall Street consensus of $79 to $81 that never came down to meet the crashed price. When the correction changes the price, but not one single fundamental of the thesis, that's historically the kind of setup that rewards patience over panic. So let me lay out three concrete scenarios. Scenario 1, the bullish recovery. The Fed holds or sounds dovish on July 29th, real yields ease, and silver reclaims $60, then grinds toward the 62 to 64 zone as the gold-silver ratio compresses toward 65 to 1. If industrial demand data stays strong and inflation keeps cooling, the path toward the 70-plus analyst targets reopens over the following quarters, and the $57 level gets remembered as the correction bottom. Watch for a Fed hold, the gold-silver ratio dropping below 65, and a decisive close above $60 on strong volume. Scenario 2, the choppy consolidation, arguably the most likely near-term path given the explicit warnings of wild volatility. Silver stays trapped between roughly $54 and $60, whipsawing on every Fed comment and every inflation print, building a base while the market waits for a clear directional catalyst. The structural deficit keeps grinding in the background, above-ground stocks keep draining, but price goes nowhere fast for weeks or even months. Patience and sensible position sizing win. Traders who chase every $3 swing get chopped up and stopped out. This is the classic cheap but waiting for a catalyst scenario, and it can test the resolve of even committed bulls. Scenario 3, the disappointment and retest. The Fed surprises hawkish on July 29th, or inflation reaccelerates on another energy shock, and silver's industrial vulnerability drags it back down to retest $54 to $55 support, possibly the $52 zone or the high 40s. Even here, the structural thesis survives as long as that support broadly holds and the deficit persists. It would simply be a lower, more attractive accumulation zone against an unchanged fundamental backdrop. The long-term bull case only truly breaks if the supply-demand structure itself reverses, if the deficit flips to a surplus, if industrial demand collapses, if a substitute for silver's conductivity emerges at scale, and there is no sign of any of that happening. Here's your data checklist for the weeks ahead, the specific things I'd track to know which scenario is unfolding. 1. The FOMC decision. July 28th to 29th. Hold versus hike is the single biggest near-term driver, full stop. 2. Chair Warsh's press conference language for September signals, since this meeting has no dot plot. 3. The gold-silver ratio, a drop below 65-1, confirms silver outperformance is underway. A rise back above 70 is a warning sign. 4. The next CPI print, continued cooling below 3.5%, is silver positive and keeps the Fed leaning dovish. 5. The $60 resistance and the $54 to $55 support is the clear range boundaries. 6. Industrial demand data, especially solar installations and semiconductor consumption. And 7. Real Treasury yields and the dollar index. Falling real yields and a weaker dollar are the specific fuel silver needs to run. Here's the bottom line, and sit with this. Silver crashed 52% from $121.62 to around $57. But the crash was driven by 3 reversible macro factors: a hawkish Fed, a hot May inflation print, and industrial demand fear, not by any change to the underlying market. Meanwhile, the supply deficit widened to 46.3 million ounces in its 6th straight year. Above-ground stocks have drained 762 million ounces since 2021. 74% byproduct supply can't respond to price. 58% industrial demand keeps growing. The gold-silver ratio at 69-1 says silver is historically cheap. Inflation is cooling to 3.5%. The Fed is boxed in by a $39 trillion debt, and every major bank still targets $75 to $100. The price fell. The case did not. That's the entire story, and now you have every number to judge it for yourself. If this data-packed breakdown gave you numbers and context you can't find anywhere else, smash that like button. It tells the algorithm to push this to more people who want real analysis instead of hype. Subscribe and hit the bell, because the FOMC meeting on July 29th is going to move this market hard, and I'll be breaking down exactly what it means the moment it lands. Comment below. Do you think silver reclaims $70 this year, yes or no, and which scenario are you positioned for? I read every single one, and I genuinely want to know where your head is at. And remember, nothing in this video is financial advice. I'm not your financial advisor, and I'm not a commodities broker. This is data analysis and education based on the numbers available right now, and silver, with its notorious volatility and a binary Fed meeting directly ahead, can move violently in either direction. Never invest more than you can afford to lose. Do your own research, size your positions sensibly, and think in quarters and years, not days. The people who win in precious metals are the ones who understand the structural story and have the patience to sit through the volatility that shakes everyone else out. Stay sharp, stay data-driven, and I'll see you in the next one.